Hello and welcome to Credit Score and AMP, Card Savvy, the channel where we break down the complex world of credit scores, credit cards, and now, investing, into simple, actionable steps you can actually follow. If you're serious about building wealth, understanding how investments work is not optional, it's essential. Before we begin, make sure you hit that subscribe button and turn on notifications, so you never miss our weekly videos that help you make smarter financial decisions. Joining our community means you'll always have insider tips, clear guidance, and the motivation to keep improving your financial life. Chapter 1: Why you must learn to invest early. Many people think investing is something for the rich, or for people in suits working on Wall Street. But the truth is, investing is for everyone. If you have even $1 a day, you can start. The earlier you begin, the more time your money has to grow thanks to the power of compound interest. Let's imagine two friends. Emma starts investing $100 a month at age 22. John starts at age 32, also investing $100 a month. By the time they both turn 62, assuming a modest average return of 7% per year, Emma will have over $240,000 more than John, even though she invested the same amount monthly. Why? Time in the market beats timing the market. Chapter 2: Understanding the basics. Before you put a single dollar into investments, you need to know some key terms: assets, things you own that can increase in value, stocks, real estate, etc. Liabilities, things that take money out of your pocket, debt, loans. Return on investment, ROI, the percentage of profit you earn from an investment. Risk tolerance, how much risk you are willing to take without losing sleep. Example: if you invest $1,000 in a stock and after 1 year it's worth $1,100, your ROI is 10%. But if the stock drops to $900, your ROI is 10%. That's why risk tolerance matters. Can you handle seeing your investment drop temporarily? Chapter 3: Different types of investments. 1. Stocks, equities. Buying a stock means owning a small piece of a company. If the company grows, so does the value of your stock. Some pay dividends, regular payments to shareholders. Example: you buy 10 shares of Apple at $150 each equals $1,500. A year later, the price goes up to $180. Your investment is now worth $1,800, plus any dividends you may have received. 2. Bonds. You're lending money to a government or corporation, and they pay you back with interest. Less risky than stocks, but also lower returns. Example: you buy a $1,000 bond with a 5% annual interest rate. Each year, you get $50 in interest until maturity. 3. Mutual funds. These pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Great for beginners because professionals manage them. 4. ETFs, exchange-traded funds, similar to mutual funds but traded like stocks. Usually cheaper and more tax-efficient. 5. Real estate, buying property to rent or sell for profit. You can also invest in REITs, real estate investment trusts, without owning physical property. Chapter 4: The power of compound interest. Albert Einstein reportedly called compound interest the eighth wonder of the world. Here's why. If you invest $1,000 at 8% annual return, year 1, $1,080 year 5, $1,469 year 10, $2,159 year 20, $4,661, you're not just earning interest on your initial amount, you're earning interest on your interest. That's how wealth grows exponentially. Chapter 5: How to start investing step by step. Step 1: pay off high-interest debt. It doesn't make sense to invest at 8% if you're paying 20% interest on credit cards. Step 2: build an emergency fund. Aim for 3 to 6 months of living expenses in a savings account. Step 3: choose an investment account, brokerage account, for stocks, ETFs, mutual funds, retirement accounts like 401k or IRA, tax advantages. Step 4: decide your asset allocation. Young investors can afford more stocks, older investors may prefer more bonds for stability. Step 5: automate your investments. Set up automatic transfers so you're consistently investing, no matter what. Chapter 6: Common mistakes beginners make. Trying to time the market. You can't predict short-term movements. Investing without a plan. Know your goals, time horizon, and risk tolerance. Ignoring fees. Even 1% in annual fees can cost you tens of thousands over decades. Chapter 7 Real-life example portfolio for beginners. Let's say you have $500 to start and can add $100 per month, 50% in a total stock market ETF, e.g., VTI, 30% in a total international ETF, e.g., VXUS, 20% in a bond ETF, e.g., BND, over 20 years, assuming a 7% average return, that could grow to over $55,000. Outro, with reminder to subscribe, and that's your complete beginner's guide to investing. Remember, the most important step is starting. Even small amounts invested consistently can create life-changing wealth over time. If you found this video helpful, hit the like button, share it with someone who needs to start investing, and subscribe so you don't miss our upcoming content that will guide you to financial freedom.